Welcome to today's market update. I'm Noah Dreyfus, CIO of Dreyfus Capital Management. Today's update will be called The Perception of Value. We will cover trends that investors should focus on and the forecast for the markets. This content is for informational and educational purposes only. It is not intended to meet the objectives or suitability requirements of any specific individual account or to be considered a solicitation for the purchase or sale of any security. You should consult with your own advisors before engaging in any transaction. Dreyfus Capital Management takes no responsibility in any action taken by investors on their own based on the content in this video. Earlier this year in our market update, This Cuts the Deepest, we noted that the stock market looked like it had peaked in mid-February and was headed further down. At the same time, we foresaw the tariff sell-off, and we were already reducing our equity exposure by more than 10%, buying gold and short-term bonds with the proceeds of our sales. Sure enough, markets sold off an additional 14% into April. But while panic was spreading, we took the opposite approach. We sold gold and short-term bonds and bought quality assets like the S&P 500, NASDAQ 100, and NVIDIA stock individually at prices near the bottom. Since April 17th, markets have rallied hard. So our first question is, why did we step back into the markets at that time, and what drove the rebound? Back in March, fear was clear. Investors were worried about tariffs, slowing government spending with DOGE, and geopolitical tensions from Ukraine to Israel. The move was that austerity would collapse growth, something like Greece in the Eurozone crisis or UK in Brexit. That drove the market sell-off. But as Howard Marks has said, when markets are ready to be bought, you probably won't be ready to buy them. Fear was overstating the risks. If tariffs eased, government austerity slowed, or if wars stabilized, markets had room to resolve higher. This is part and parcel of what Dreyfus Capital does. Analyze the markets, find the predominant thesis, find the holes in that thesis, and advantage our clients as a result. Our counter or antithesis is exactly what happened. Max pessimism was already priced in, and when the markets realized it wasn't as bad as originally thought, stocks rebounded over 34% from the lows. Fast forward to today, the pendulum might be starting to swing too far the other way. Markets are now at all-time highs, even with tariffs of 10% or more on foreign exports, which we don't know the full results of yet. One could speculate that optimism may be the primary driver in the market rather than economic fundamentals. This isn't the first time we've seen optimism and liquidity fuel risky behavior in the markets recently. Remember 2020 and 2021? With rates at 0% in 2020, money was free to borrow, and investors chased the stock market along with other assets like real estate, SPACs, IPOs, and unprofitable companies. As we can see on the right, this is a list of unprofitable companies that surged in 2021 with a bubble-like behavior and have since not fared too well. Then in 2022, when the Federal Reserve raised interest rates from 0% to 5%, liquidity dried up and the bubble burst, causing the market to fall approximately 28% from peak to trough. Investors relearned a fundamental lesson during this period. When interest rates fall, liquidity fuels asset bubbles, and the prices of the assets in aggregate increase. When interest rates rise, asset bubbles deflate, as now investors have to pay a price in order to speculate. Looking at the market today, the S&P 500 and NASDAQ have nearly doubled since COVID. If asset prices deflate because of lower liquidity, now that borrowing is expensive, then why would the market inflate during a period where interest rates are still relatively elevated? In order to answer that question, let's take a look at how interest rates affect spending. Let's say, for example, the Federal Reserve sets lending policy at 2%. Banks offer loans at a margin above the federal lending policy. Let's say, for example purposes, 1.75%. So now consumers and businesses borrow at an effective 3.75% rate. Now, businesses and consumers can afford the payment on this rate because they're using the loan to grow and scale their lifestyles and businesses at rates above 10%. Now, let's say the Federal Reserve resets lending policy from 2% to 5%. Banks still offer the loans at a margin above the Federal Reserve lending policy, let's say 1.75% for our example. Consumers and businesses are now borrowing at an effective 6.75% rate, which they cannot afford because they are risking the capital of the loan on a bet that they can generate above 10% returns. And if they are successful, they only make a small margin, let's say 3%. So back to our question of why the market rebounded so quickly. Even while the Federal Reserve was raising rates, the Federal Reserve and Congress injected trillions of dollars into the financial system. So while the market has effectively doubled since COVID, if you look at the balances that the Federal Reserve holds on its balance sheet, they went from high $3 trillion to over $9 trillion. And now they are still at an elevated $6.6 trillion, or effectively double where they were before COVID. If you also look at the amount of money in circulation, we went from pre COVID at $15 trillion in total currency in circulation to over $22 trillion as of today. So if you want to understand why the market rebounded so quickly, it's because the amount of money in circulation went up so quickly. That money in circulation has to chase an asset or a good or a service. In this case, the amount of money that was put into the financial system circulating went towards risk assets. So where's that money going now? While a lot of the liquidity has fueled amazing companies like the growth in Nvidia, Microsoft, and Meta, amongst others, a lot has also gone into speculative assets. Below, you'll find a list of companies that are not profitable, yet so far this year have gone up measurably over the market. One of those companies is Open Door Technologies, a real estate company. Investors might be curious as to why Open Door is up over 170% this year. Let's take a look at the balance sheet. When we look at the balance sheet, the net income for Open Door Technologies is negative $300 million per year. At the same time, the total amount of cash they have on balance is $789 million. Now, if Open Door Technologies doesn't dilute their shareholders by selling new shares or take on debt, they'll be effectively bankrupt in less than 3 years. Does this seem like a market acting rationally? But it's not only Open Door Technologies. Let's take a look at 4 new IPOs to the market this year, or initial public offerings. All are up 100% over their initial public offering price, while at the same time, Bitcoin, Ether, and XRP are up double-digit in returns. This furthers our thesis that these rallies are not driven by underlying economic fundamentals, but they are more about speculation, buying an asset because someone else might pay more for them in the future. However, buying an asset because somebody else might pay more for it in the future is not investing, it's gambling. Real investing means buying companies with the ability to generate profits that exceed the risk-free rate of a treasury bond. So let's say right now you can get a treasury bond for 4%. You are looking to invest in companies that generate profits measurably above that 4% rate, either and those are paid out either in dividends or reinvested profits to justify the risk of investing. Otherwise, you're just hoping for a greater fool to come along to pay more for an asset than you paid for. A notable investor named Howard Marks, who we mentioned earlier, who also predicted the dot-com bubble back in 2000, 2001, has released a memo calling today's market a bubble. Let's take a look at a few minutes of his most recent podcast.
In my parlance, the value of an asset is derived from its fundamentals. The fundamentals of a company, for example, encompass a great many things. These include its current earnings, its earning power in the future, the steadiness or variability of its future earnings, the market value of its component assets, the skill of management, its potential to develop new products, the competitive landscape, the strength of its balance sheet, and the myriad additional factors that will influence the company's future. Ultimately, the totality of an asset's fundamentals constitute its earning power, which in turn is the source of its value. I describe earning power as the money you can make by owning and operating an asset. That is, I omit from earnings the possible gains from simply holding an asset and ultimately selling it. A diamond ring, painting, or classic car doesn't produce earnings for its owner, short of renting it out or charging people to look at it. I think of assets that don't produce operating cash flow or have the potential to do so in the future as not having earning power, and that makes them impossible to value objectively, analytically, or intrinsically. While value can seem theoretical and ephemeral, price is concrete. It's the amount you pay to obtain something. Ultimately, as just mentioned, doing a good job of investing comes down to estimating value appropriately and purchasing that value at a reasonable price. Just as an imbalance of opinion in one direction or the other can move the price of GM, it can also move a whole market. Sometimes the overall mood of investors in a market is positive, meaning they're characterized by optimism, credulousness, fear of missing out, FOMO, and risk tolerance. When the majority of investors are optimistic, they cause price to rise and potentially exceed value. And when the pessimists reign, they cause price to decline and potentially fall short of value. Thus, a preponderance of investor psychology on one side or the other, in lieu of the rationality and objectivity on which the efficient market hypothesis is predicated, can create the bargains or overpricings the hypothesis says can't exist. Investors should be on the lookout for them. The price of an asset means nothing in isolation. You can't tell whether a car is a good buy at $40,000 unless you know about the things that determine its market value, its make, model, age, mileage, and condition. It's the same in investing. What matters is the relationship between an asset's price and its value. Investors call that relationship the asset's valuation.
The last several months have shown us how quickly markets can swing from optimism to fear and back to optimism. Earlier this year, many investors assumed the worst and sold heavily into the news of the tariffs, which created opportunities for us to buy strong assets at attractive prices. That discipline paid off as markets rebounded. Today, however, we are seeing the other side of the coin. Stocks are at all-time highs, speculative assets are surging, and prices in many cases have moved much faster than underlying business fundamentals. History tells us that when valuations reach these levels, future long-term returns from levels like these tend to be limited. At the same time, it is likely that this trend of assets inflating will continue for the near future, especially if the Federal Reserve restarts a path of cutting interest rates. Remember, cutting interest rates fuels liquidity into the market, and when liquidity enters the market, that causes aggregate prices of assets to rise. The market may experience something similar to 2021, as we noted earlier, in the case that the Federal Reserve does cut interest rates in September. In the short term, the market rapidly rising can seem euphoric, and being prudent during these times can lead to feelings of missing out. These periods rarely last, and I believe it is time to begin being more prudent in our investments. For long term investors, the takeaway is simple: success comes from patience, discipline, and staying grounded in fundamentals rather than emotion. Buying when fear dominates and being prudent when optimism runs high is rarely comfortable, but it has always been the most reliable path to lasting results. Thank you for listening.